we have some total return stocks for you today that also have high return on assets. Hold on to your seatbelts, folks. This is going to be a good one. Return on assets, or simply ROA, is a valuable fundamental for investors because it gives us some insight into how efficiently a company utilizes its assets to generate profits. This is also generally a good indication that their management team is on the ball. ROA itself is a simple calculation, as it is the company's annual earnings divided by their total assets. ROA can also be very useful for comparing companies within the same industry where asset utilization and operational efficiency can vary quite significantly. High ROA values often indicate a company that's more efficiently managed, suggesting a potentially more profitable investment compared to lower ROA companies. I like ROA because, well, it takes into account all of the company's assets, we're talking both debt and equity financed. Thus, it is an excellent tool for evaluating the core profitability of a company, regardless of how it's structuring its capital. By focusing on assets, investors can get a sense of how well a company is being run, rather than just how it performs financially. In a nutshell, a higher ROA can be a sign of a company that is likely to generate more profit from each dollar of assets, making it an attractive option for investors looking for, efficient, profitable companies to add, of course, to their portfolios. Join today's conversation. Let me know in the comments if you use ROA in your due diligence. Thank you for your participation. If you love this sort of content, be sure to subscribe for more. And another huge thank you for that click. For the stocks I found today, there were, as usual, a few qualifiers. First, they had to have a bare minimum ROA of 5 or better. They needed to have at least a dividend yield of 2% or better, as we're looking for total return stocks. Lastly, they needed to have a positive total return for the time frames we're looking at today. So basically your 3-year, 1-year, and year-to-date. Today's list is, of course, sorted by their year-to-date total return. So without any further ado, let's do this. Kicking off this list, we have Olympia Financial Group with ticker OLY. They are based out of Calgary, and they are a financial services company with a diverse array of services that include health and dental benefits, foreign currency exchange, as well as some pension services. Their current price at the time of recording is $104.25. They have a market cap of $250.86 million, a very stable beta of 0.37, so there's not a lot of volatility with this one. Their earnings per share come in at 9.48, and they have a PE ratio of 11. That return on equity, it's a little high. It's coming in at 79%. And the return on assets are coming in at 17.77%. These are both highs for this list today. A lot of times when you do see inflated ROE and ROA, it might be a debt situation. But when we look at their debt to equity ratio, it's only 10.10%. So it's definitely not inflated because of debt. So I'm gonna give them this one. Switching gears to returns, their dividend yield comes in at 6.906%. It is a monthly dividend of 60 cents per share. They have a payout ratio on that of 55.06%. On the 3-year, their return on investment comes in at 121.81%. Factor in the dividends, we get a total return of 149.11%. On the 1-year, 16.87% return on investment. Factoring in the dividends, we get a total return of 24.10%. And this year-to-date, their return on investment, 7.47%, total return of 9.33%. The whole financial sector should benefit from rate cuts, so it could be a good year ahead for Olympia. Coming in at number 4, we have Wajax Corporation with a ticker of WJX. They are based out of Mississauga, Ontario, and they provide equipment, parts, and services to various sectors, including construction, forestry, mining, and oil and gas. They have a current price of $33.38. Their market cap comes in at $723.33 million. Their beta, it's almost twice as volatile as the market average. It comes in at 1.90. They have earnings per share of 3.64, and their PE ratio, that's sitting at 9.17. Their return on equity, nice looking, 17.12%, and they have a return on assets of 6.22%. Their debt to equity ratio, it's a little higher. It's up there at 100.93%. Switching to their dividends, they have a yield of 4.94%. It's a quarterly dividend of 35 cents per share. The payout ratio on that is 36.26%. If we look at their returns, on the 3-year return on investment, that comes in at 69.53%. Total return after we factor in those dividends of 86.90%. On the 1 year, they have a return on investment of 43.51%. Factoring in the dividends, we get a total return of 49.27%. Year to date, return on investment 9.37%. Factor in some dividends, we get a total return of 11.60%. Wajax has great diversity, and between the oil and gas sectors and construction, they are sitting in a pretty nice place. Taking our third spot, we have Gibson Energy Incorporated with a ticker of GEI. They are also based out of Calgary, and they engage in the gathering, storage, optimization, processing, and marketing of liquids and refined products in Canada and the US. Their current price comes in at $22.90, and they have a pretty big market cap of $3.70 billion. Their beta, just a little more volatile than the market average, up there at 1.29. We have their earnings per share coming in at 1.41, and we have a price to earnings ratio of 16.24. That return on equity, even nicer than the last one, 28.84%, and their return on assets, 5.83%. So that's not bad either. Their debt to equity ratio, now this is one that bugs me a little bit, 303.96%. Now, their dividend yield, it is the highest on the list today at 7.162%. It's a quarterly dividend, 41 cents per share. The payout ratio, yeah, it's not sustainable at 110.64%. Looking at their returns, their 3-year return on investment comes in at 7.26%. Factor in the dividends, we get a total return of 28.06%. On their 1-year return on investment, that comes in at 2.10%. Factor in the dividends, we do get a total return of 9.05%. On the year to date, their return on investment, that comes in at 12.97%. Factor in the dividends, we get a total return of 14.90%. As the energy sector surges, they should do well. And the rate cuts will help servicing that kind of oversized debt. This one is more risky than the others, but if they can work on getting their debt down, this could be a great opportunity in the future. In our almost top spot at number 2, we have Dynacor Group Incorporated with a ticker of DNG. They are based out of Calgary, and they are engaged in gold production by processing ore purchased from the artisanal and small-scale mining industry in Peru. They're priced nice and small at $4.95. They have a market cap of $180.79 million. Their beta, pretty close to average, 1.14, and their earnings per share come in at 0.53. They do have a price to earnings ratio of 9.34. Their return on equity, 17.74%. And their return on assets, a nice looking 13.23%. Their debt to equity ratio is 0.71%, so not a lot of debt here. You know I love that. When it comes to dividends, they do have a yield of 2.829%. It is a monthly dividend of 1.2 cents per share. Their payout ratio, pretty sustainable, 22.98%. On the 3-year, their return on investment, that comes in at 106.25%. Factor in the dividends, we get a total return of 119.21%. On the 1 year, we get 58.61% for their return on investment. That total return comes in at 62.69%. Year to date, their return on investment comes in at 23.75%. After we add in the dividends, we do get 24.65% for their total return. With the price of gold on the way up, this could be great for them. But of course, if gold were to slide, those returns may come down with it. Luckily, it does not look like gold is going to underperform anytime soon. In our top spot at number 1, we have Bird Construction with a ticker of BDT. They are based out of Etobicoke, Ontario, and they are a premier building company that specializes in commercial, institutional, retail, multi-tenant residential, industrial, mining, water, wastewater, energy, renewables, nuclear, and civil sectors, focusing, of course, on growth, diversification, and profitability. Their current price comes in at $19.03. They've got a nice looking market cap of $1.03 billion. Their beta, a little bit of volatility, but not much, 1.21. Their earnings per share come in at 1.33, and they have a price to earnings ratio of 14.31%. Their return on equity, 24.03%, and their return on assets, 5.40%. They have a debt to equity ratio of 46.93%. Switching over to dividends, they have a yield of 2.945%. It is a monthly dividend of 4.7 cents per share. Payout ratio pretty sustainable at 26.42%. When we look at their returns, on the 3-year, their return on investment comes in at 111.21%. Factor in the dividends, and we get a total return of 124.79%. That's not too shabby. On the 1-year, we actually get more. We get a return on investment of 115.76% and a total return of 120.66%. How are they doing this year? Their year-to-date return on investment comes in at 31.79%. Factor in the dividends, we get a total return of 32.35%. Construction is going to be huge as Canada builds more houses and infrastructure. Bird construction is poised to have another good year or two, or maybe even 5. Overall, I do like these companies. They have a lot of potential to perform well this year, and the only real concern I have is, well, why don't I have any bird construction in my portfolio yet? If you are interested in any of the stocks that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Well, let's continue that learning journey. Check out this video on Canoe EIT, and I will see you in the next video.